48 hours. That's all it took for Silicon Valley Bank, the nation's 16th largest bank, to collapse. Then Signature Bank followed suit, and First Republic and more are showing signs of contagion. President Biden and bank heads are pressing hard to reassure Americans their deposits are safe. But there are major questions about how the industry experienced the second worst collapse in U.S. history, seemingly overnight. What signs were missed, and who's responsible? I'm joined by Bartlett Naylor, financial policy advocate for Public Citizen. Bartlett, ultimately, SVB made a ton of mistakes. Which is the most egregious to you? And do we have a reason to fear that other banks are making the same mistake?
Well, the simple mistake is that they bet the Federal Reserve, would raise rates as quickly and as precipitously as they did. They took in a ton of cash, in part from some of their clients who are startups funded with venture capital and loans from Silicon Valley Bank. And they sort of required them to keep that cash in the bank rather than do the hard work of making good loans that is what a banker should do. They used that cash and just stuck it in low interest bearing treasuries and other securities. So when those securities paying low interest rates were devalued by the market because people can get a higher interest rate now with the Fed raising rates, they were stuck. And this is a basic problem of all banking. It's called a maturity mismatch, but all banks have that. So you would think that Silicon Valley Bank should be, smart enough to be able to figure it out, as most of the other 4,000 banks in the United States have done.
There's also a lot of fingers being pointed at regulators here. Should they have caught red flags before the bank run? If so, what did they miss?
Well, some of it is self-inflicted wounds. Congress passed a law in, I forget, it was 2018 or before, it's as S2155, which reduced the requirements of strict supervision for banks as big as $250 billion in assets. Before that, it was $50 billion in assets. And that's just where Silicon Valley Bank sits. They're at 200 or something billion. Second thing is that the regulators, the Federal Reserve in particular, it was 2018, said that the stuff you have that's liquid, namely stuff you can sell by way to meet customer demand, depositor withdrawals, doesn't have to be as liquid as it once was. And again, they said that's cool for a bank as big as $700 billion. So both of those, both the law and the regulatory action, we think were misguided and helped enable the bad bet that Silicon Valley Bank made, and hence its failure last Friday.
Okay, President Biden did address that this morning. Let's take a listen real quick.
Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
And he's talking specifically about that 2018 law that you spoke of that did have bipartisan support to roll back those regulations on banks the size of SVB. Do you actually think that that would have made a difference? If the regulations had been in place for a bank the size of SVB, under $250 billion, would it have made a difference in this case, or is this a political talking point?
Tough question, tough to prove a counterfactual. They were not empowered. They were empowered to do something. They were empowered to make a bad bet. There are other banks that are under scrupulous supervision that are capable of making terrible bets as well. J.P. Morgan made a horrific mistake known as the London Whale, and they were under strict supervision and lost 10% of their capital in that stock price declined precipitously. So big banks under strict supervision that had nothing to do with the law that President Biden just mentioned also do bad stuff. But I'd like to think that the supervision required from Dodd-Frank, the 2010 law, is such that these large banks above $700 billion are a lot safer than they were before leading up to the financial crash. I do believe 2155 enabled it, but it's one thing to enable it, and it's another thing to have a bad manager that takes the money and goes to the casino and loses it all.
Let's go back to SVB for a second. In one day alone, they faced $42 billion in attempted withdrawals. That's nearly a quarter of their deposits. That would be nearly impossible for most banks to meet that demand. Or is it? You tell me. When a bank run of that magnitude takes place, is there anything that the bank can do?
Well, there really isn't. These are uninsured deposits, so everybody is insured up to $250,000. But these are small startups and other firms that have multi-million dollars, or cryptocurrency firms that are having a stable coin, in the case of Signature, where there's bunches of millions of dollars, and they want to take them out because it will be unsure. It will be frozen in this bank, short of what the regulators did over the weekend, saying that all those uninsured deposits are going to be insured, they're going to get their money back if they want them. That is a problem with having uninsured deposits, and it is a problem for a smaller business, a pizza shop or something, or a 50-person operation that does have $1 million weekly payroll or biweekly payroll. Maybe there should be something said about increasing what is insured. Although the big boys, I'm personally not sure we should raise it to everything. I think that's a good discussion for Congress to have. I think one problem is that with banks is that their creditors don't really have to do the due diligence that creditors have to do with any other company. If any other company goes bust, the creditors are out, or they have to wait in line to get their money back. But with deposit insurance, a banker can kind of go wild, knowing that his creditors, in this case depositors, are going to be made whole by the government. It's a moral hazard, and I am quite concerned with the precedent that we are making all of these uninsured depositors whole.
Let's zoom out a little bit and look at the banking world as a whole, which is so much different from even 2008 and the crash that we saw. The markets are moving and reacting 24/7 around the world. Banking now is more on demand than ever before. We can all pull money from our phones. And then we have social media, and connectivity means we're up to date to the minute on the phenomenons and fears that are happening, like the fears that were surrounding SVB. How are regulators failing to keep up with this new kind of environment where we're so connected and in tune with what's going on and seeing that reactivity happen in real time?
Well, you make very good points, and much as regulators and our president is trying to reassure us, this system runs on faith, as opposed to your automobile, which runs on something that you can take apart as an engineer and know exactly why it's happening. A lot of this runs on faith. My personal view is that a lot of problems solved if we change the rules for banker pay, and that is to say, bankers get paid if they do really well, and they don't get punished if they do badly. Dodd-Frank has a rule, Section 956, that says there can't be banker pay that incentivize inappropriate risk-taking. Now, you can imagine banker pay is possibly the thing that they care most about, and I think it's revealing that while that law was supposed to be implemented in May of 2011, it is still not implemented. Section 956 remains unimplemented, and it needs to get done. As we all know, infamously, the day of the failure, hours before the failure, these senior bankers paid themselves some nice bonuses. So if that was prohibited, if the incentive to get rich off making bad decisions was removed, I think a lot of these problems would go away.
Bartlett Naylor, financial policy advocate for Public Citizen. Really appreciate your insight today.
Thank you.
At Straight Arrow News, we don't care if you're liberal, conservative, or independent, because you deserve the facts and the unbiased truth. So join us in our mission at straightarrownews.com.